Welcome, everybody. This is already December of 2024. It's usually a little slow time of the year. Quarter one traditionally is very slow, but yeah, man, has 2023 been a very unusual year with cap rates going up with interest rates. And yeah, I think what we look forward ahead is diversifying. That's what you're seeing with the tax PAL fund, a little bit outside of real estate. Definitely opportunities coming up. But yeah, I think what you guys are going to see is a little bit of a short-term defensive strategy coming from the deal flow up in the future here. The urgent thing this month, get in before the 10th is our normal deadline. We might extend it a few days because this is the big deadline, because next month the bonus depreciation goes down to 60%, meaning $100,000 investment in the tax PAL fund this year will get you $80,000 of passive activity losses. And next year, it's going to be 60%. The tax PAL fund, it's got that high pref on there, but it can be a little bit misleading. Again, the big thing and why it's called tax PAL fund is for those passive activity losses. And it's way higher if you invest this month than next month. So some questions surrounding the tax PAL fund. First question, is it confirmed in the PPM that the operator will dip into the profits in order to hit the perform projections, or that the operator may do this? Basically, is this a requirement spelled out or optional? Basically, the investors are getting that 24.9% pref. Now, it does not necessarily say that the operator will pay this, right? And that's because that is not what a preferred payment is. Preferred is not necessarily guaranteed. And I think all investors need to understand it. If you don't, ChatGPT it, Google it, watch YouTube videos on it. But essentially, if there are money made in the investment, the preferred rate of return means that investors get that first. So therefore, if the investment is not making that pref, then that does not get distributed. But obviously, the operator wants to make money, right? Pay payroll, keep the lights on, run a profitable business. And if they don't hit those performance, then they don't get to eat. They don't make any money. So whenever you see a pref in there, whether it's 8% or 24.9%, that always is better for the passive investor, at least in the short term, to get paid first. In the past, but that's what the PPM does say, right? Of course, everybody needs to, I'm not giving any tax legal advice here in this presentation. Everybody needs to go and read the PPM as the final say. But that is what preferred rate of returns essentially are, is investors get paid first. In the past, did some checking over the last several years, and the operator has always made these preferred payments out to investors. Only once did they not hit their projections in terms of the money they wanted to make, and that was March of 2020 when the world shut down. And in this case, the operator did indeed pull from their reserves and pay out the preferred return to investors for that month. But I think the real question that needs to get asked is this next one from another investor asking, we want to know what is the operator's profits, right? Because if the operator is making good profits, then I, as the investor who's getting paid my preferred rate of return first, am covered, right? Essentially, I'm trying to figure out my margin of error in order to determine the safety of the performer projections. And as I said earlier, this has only dipped into there 1 month out of ever. I went digging, and the profit margin is typically around double the preferred rate of return. So they're typically earning about 50% annually, which they could distribute that 25% out to investors. So that's pretty consistent with obviously a big range of when you say businesses, but most businesses run at that type of expense ratio, meaning that they can have a really bad month where they only hit 50% of their marks and still be able to make investors whole that month. Of course, that's why any good business owner carries reserves, and why I think investors out there should have a nice little reserve account, 20, 40 grand at most. I think most people need. But any business kind of does carry at least 6 figures of reserves to pay these types of things as they do come up. But here's another way of viewing it is like the big picture is this deal is structured where think of it like a revenue share on the money that's come in. Of course, the revenue is coming in from multiple places, but essentially it's coming from those ATM fees where the landowner receives 33 cents of every dollar, the operator gets 33 cents, and us, the investor, get the other 33 cents. So you can see how you see the exact ratio there, right? The operator gets 33 cents and we get 30 cents. So that's where it breaks down from. As for and as I said, yeah, as far as another risk perspective, the most challenging month was that March 2022 when the operator pulled from the reserves to cover the pref. Next question, can you share how many ATM deals your group has previously done? How did they fare? Those that did not do well, what was the recourse? So dating back to 2017, many of our investors have successfully invested with the same operator. One noteworthy point is that the operator has consistently maintained a record of never missing preferred payments, even during these challenging times. We certainly value the operator's track record and the fact that they're a top 4 operator in the country. And there's a lot of security financial checks that goes along with it. You can't just jump on the ACH network without a lot of these third-party checks from regulators. One of the additional layers that's my role in this is when we invest as a group, if there's any type of things that go wrong, I step in and lead the charge and from a legal matter on behalf of investors, as I'd like to get my money back too. This additional layer of security can be reassuring. I've seen it happen many times as a passive investor where the general partner goes dark on investors, which is something I think that I take great empathy in. And again, because I was there at one time. And I think investors, or at least speaking for myself, I can stomach when investment is struggling, there's occupancy or interest rates. That's very understandable. We're all in this boat together, right? We're all big kids. But what I just can't stomach is like when you're dealing with nefarious, dishonest people that are doing shady things. And that's something I have a zero tolerance for. And especially when we're going in as a group like this within scale, it definitely makes sense to lawyer up, right? Nobody likes lawyers. They ultimately just draw up fees and makes the case when you're investing less than $250,000. It makes it absolutely a case where you're throwing good money at bad money, just paying the lawyers to collect at best pennies on the dollar of any type of settlement like that. But when you go in as a larger group like this, we step up to the plate with real representation as opposed to a little LP investor who's just in there trying to get what they can. And then ultimately, to me, to mount any type of legal presence, you're going to have to look to spend 6 figures at least, and especially all the time. And I think that's something that we have the team to rely on, at least, and I have the money to fight it on investors' behalf. But that's why you always try and do your due diligence first and always work with people like and trust, and within the community, a track record of a lot of people have invested in the same type of investment for quite some time. I think I mentioned earlier, I've been pretty aware of this investment since 2000, seen many people invest through it. Question, would pet fund invest in a tax style fund? Likely not. And I think the reason being is that the taxes, that's just a strikeout right there. Pet fund has 1099 ordinary income. You lose the tax benefits when you do it. And that was something where I know Peter's having a lot of individual conversations with investors about the tax style fund. I'm seeing some people, like one guy was using retirement funds, and I was like, hey, Peter, you might want to talk to that guy. Of course, we don't give tax or legal advice. We now have the professionals. If anybody wants a referral to those tax legal people, the same folks that I'll personally use, we can pass you guys over that way. I don't get myself into trouble giving tax or legal advice. But in my opinion, and I'm not giving any tax or legal advice here, using a self-directed IRA, any kind of qualified retirement plan is really silly to invest in the tax style fund, because sure, you get the losses, but those losses stay within your qualified retirement plan, your retirement account. It stays insulated in a vacuum there. What it doesn't do is come back to you personally and to help you on your personal taxes, which to me is why the heck you're doing the whole thing. I would say what people will normally use those retirement accounts are more asymmetric type of return type of investments, and or things that don't give you tax benefits. So if you guys invest in notes, get paid through 1099s, is the latter. And the more asymmetric returns would be like development deals, larger returning types of deals, higher risk, higher return type of deals would be more lined up to retirement funds. But that said, you always try to invest your cash into tax advantage types of projects first. But I get it. If you're somebody who doesn't have a lot of cash because you've invested through your retirement account your whole life, doing it the way they said you were supposed to do, unfortunately, now you find out it's the wrong way of doing it. And it was only the way that they kept you in all those traditional investments that whole time. Then you're faced with a difficult situation of pulling out your retirement account funds, paying a little bit of taxes on it now. That said, it'd probably be a lot less than in the future, and playing that game. And that's where we really get into more personal finance. And if anybody has any personal situations, we can always go through that on these office hours. Of course, you can always say asking for a friend, right? But that's where every situation is a little bit different, and it is really based on your adjusted gross income, where you fall in those tax brackets, how much money or where your money is stored, cash, retirement accounts, real estate, rental properties. And I actually really enjoy doing that, strangely enough. And that's maybe why we started this whole wealth elevator platform. Next question. I'm trying to hit the $200,000 a year test for the past 2 years. I have the following types of income in addition to W-2. Long-term rental income properties are managed by property management via short-term rentals. Okay, this question is us talking about, I think, hitting material participation hours using that short-term rental loophole. I'll admit I am not an expert nor even I know the trick a little bit. Essentially, what a lot of people are doing who, these are your high W-2 people, high W-2 income people. So people who make over $200,000, $350,000 a year. If you're under that, this doesn't really pertain to you guys because you guys don't really pay too much taxes as it is. What people are doing in these situations, because they cannot qualify for real estate professional status, meaning that they have a full-time day job and their spouse does too, and they can't really justify not going part-time. They have to work their jobs, right? And because they're in that growth stage, that first 2 floors of the wealth elevator, where you're building up equity. And in most cases, we see families, couples where you have both spouses working like an airplane with 2 engines. They're both running hot. In those cases, I say get your net worth to a certain critical mass, maybe $1.5 million, $2.5 million, and then start to get a little bit more efficient in terms of taxes. Maybe one spouse quits their job. This can also coincide with life changes, like having a kid, having a second kid, and maybe one spouse is not forced but wants to quit, and then they go into real estate professional status mode. That said, their income may draw them under that $250,000, $350,000 threshold. Therefore, they don't have to pay that much taxes in those thresholds anyway. And that's where it's a little bit of a chicken and an egg thing. But in this case, this person's asking this question because they likely make over $350,000 adjusted gross income every year, and they have to keep working, right? They more than likely they make $350,000 a year, and it's just they need to keep working, right? And they're looking for other ways to drop their ordinary income, because essentially this is review. If you have real estate professional status and you're able to work with your CPA, of course, we've got the CPAs that are educated in the stuff that you can talk to see if you can check the box with. Now you can use all these passive losses that you get from these various syndications to lower your passive income and your entire income as a whole to lower your tax situation. In the past, people have done things like conservation easements, which are really risky due to the new omnibus bill laws. They've done oil and gas deals, but man, are those things like, that's a cowboy world. I don't do it. I'm not going to say I don't recommend anything, especially when things I don't do myself. I'll say it more strongly. I don't do oil and gas deals because I don't trust people in that world. And they'll do the short-term rental loophole that we're talking about here. Basically, you get a short-term rental, you put a little flip into it, and then for that year, you've turned some money into from the ordinary side to the passive side. And when you do that again, now it's on the passive side. Now you can use the passive losses to essentially knock it out. Now, again, I'm not giving any tax or legal advice. Talk to our referrals on that side there. But that's what this person is asking, trying to hit this $200,000 a year test, which I'm not really familiar with, but I've heard of the term. And I know enough of myself to know that this is when you start to get the professionals in there, especially the professionals that are going to check the box for you. And more importantly, if you ever get audited, they're the ones who's going to defend you on it. Next question. I'm intrigued by the concept of progressive scaling in real estate syndication investments. Yeah, you should. It changed my life and wanted to open up a discussion in theory when diversifying a substantial investment across multiple syndication deals. What factors do you believe are crucial for determining the optimal number of deals? Considerations may include balance between diversification, quality, risk tolerance, market conditions, and the potential benefits of scaling down the investment size. For those experienced in real estate syndication or investment theory, what insights can you share on the concept of progressive scaling and its impact on portfolio optimization? So an example they give for investing accounts starting at, say, $1 million of investable investments and dedicating 10% to each syndication and progressively scaling that down to, say, 3 to 5% per syndication as one approaches $10 million plus. At what point would you consider being that too many? I was leaning towards the idea of 20 max across 5 to 10 different people. I think you're starting to see how you start to transform your traditional investment portfolio through alternatives through syndications. I don't say many things are a rule, but I do see thousands of investor profiles and really nothing really surprises me today. And for people to get past a certain threshold that I feel like is required these days for financial freedom of, let's just call it $2 million net worth, to get over that threshold before a reasonable amount of time. I think it's easy for people to get past that threshold if you're 55, 65 and older, right? Because a lot of this is time, and that's the basic, I bought my house for 300 grand and now it's worth 1.5. I'm a genius, right? Like that, no, that's not. That's just pure inflation, and that's not going to get you financial freedom. What I'm saying is a 45-year-old with a net worth of 4.5 million, right? To break through to that type of level, you're going to have to put a larger concentration from traditional investments to alternative investments. Why? Because two things. You're going to get slightly higher alpha in the syndicated alternative investments, and you typically get these tax benefits that allow you to cut through and save a lot of money on taxes, right? Because if you're getting $50,000 and you're paying regular taxes on it, you may be stuck with $25,000 at the end of it. But if you're able to optimize these strategies and pay a fraction of that, you may pay $40,000 of taxes, but you net between those two scenarios, you net like $15,000. And that's where these types of incremental things build up and compound over time when you start to reinvest that $15,000 delta, as you can see in this little scenario. That's why if I look back in my investing in very early on, I went very heavy into alternative investments. In 2015, I had 11 rental properties. I want to say I still had some Roth stuff, which I ultimately just got rid of. At that time, I must have been somewhere around 50 to 70% alternative investments to get past that 10 to 20% range. That's a first step for a lot of people to understand that, yes, alternative investments cut out the middleman. That's why you're getting slightly higher alpha and you're seeing the benefits of the tax benefits. And I think most investors I see do that 10 to 20% in the first several years. And part of that is just making sure that you're working with the right people and making sure it's all real. But at some point you have to pony up, and we're getting a lot of investors to that stage where their first deals have gone full cycle and they've seen some of the successes of this, at least from the tax benefits alone. And they get to this point, and I'm not going to be the one to tell you what you do. That's always your guys' responsibility. But at some point you have to go past the 25, 50, maybe even as I did. I actually went probably 100% alternative investments from 2015 to 2020. And at that point, at the tail end of that, And then I started to do some more infinite banking, accredited investor banking, started to skew more towards 10%. That as a very conservative part of my portfolio to counteract a more aggressive alternative portfolio, which is in air quotes, because that's just in comparison to the average Joe out there, 100% traditional investments where they're getting killed with taxes, getting beat up by all these hidden middlemen in the traditional investment space. But that's something everybody needs to take a look at, self-inventory of their self, of my net worth, how much of it is in alternative investments. Now, some of you may have, if your net worth is $1.2 million, you have 600 grand sitting dead equity in your home. Technically, that's an alternative asset, but to me, it's not. I would say that money is as good as bad as like a T-bill at that point. And again, this is where the wealth elevator framework comes in, which the book is releasing this next month. So please be on the lookout for that. And if you guys want to help out for a review, please let us know. We'll probably give you guys a free copy to help us do. Or if you guys have any friends that you guys want to give them out to, please reach out, shoot us an email for that. That'll really help with the book launch. Or was I going with that? Oh, so yeah, in the wealth elevator, right, we have these floors, right? And I'm a big proponent of establishing your destination of endgame. Now, for what is endgame? For most people, that is $3.5 million to $5 million net worth, enough to comfortably live at 4 to 5% and just invest in traditional investments at that point. But when you're getting up to that point, to me, you need to grow your net worth more aggressively than the average bear out there. And that means going into a good concentration of alternative investments. So the more money you have, the less you need to do. How the heck are you going to get there is what I'm saying. And this is where, just speaking for myself, 80 to 100% of my net worth, especially starting out, getting past the first millions was in that 80 to 100% range. And therefore, coming back to this person's original idea, which is there's no right answer with this. I think this is what really toils with a lot of people who are looking for that right answer, that schools always tell you that there is a right answer. There's no right answer here, right? And I think this is where you need to interact with dozens and dozens of purely passive accredited investors, which is why we do the retreat and we allow people to test drive the group. And if you guys like us, join the mastermind group. But this is where you need to interact with other passive investors doing this type of stuff and see what are the different ideas out there. I'm just one data point. Some people say it's more, some people it's less. But if we just start off with your net worth is like $1 million, you still need to get after it. That's not enough money. And you need to start to deploy. And if you're at 10%, go for 20%. If you're at 30%, you go for 40%. It's all about baby steps. Wherever you're at, just do a little bit more, right? Don't worry about the end goal. I think a lot of people want to know what is a good end goal or what's a framework. So what I've always said is most value add projects do take about 5 years. And if you go into a deal a quarter, for a year, 4 times 5, that's 20 syndicated deals. And if you're investing 100 grand in each of those, 20 times $100,000, that's $2 million of investable assets. You only got $1 million to invest, then cut that in half. Either do $200,000 investments every half or $50,000 per quarter. But essentially, you're trying to space it out. Why? Because diversification, you never know when something happens to the economy and you want to diversify over time. I feel like anywhere from 4 to 7 years or more, you can feel pretty safe in that. Where people who are starting out, they're more exposed because their portfolio deployment is restricted to the first 1 to 3 years. When you're getting into a deal, that's the restabilization period. That's when you're most vulnerable, right? That's when it's the infancy stage. So the more you can space out your holdings, the better you're going to be. Easier said than done, right? Like, when the heck do you start? It's a chicken and egg thing. You start and 3 years now you're exposed, but you got to get through that stage. And some of it comes down to luck and timing. So therefore, the best time to start was yesterday, or don't start at all and go back to traditional investments. And we know what the heck is going to happen if you keep doing that. You're sure you're going to get killed with taxes and you're not going to grow your money. And that's what the myriad of other people out there, the average Joes, are doing. And that's why I say, again, we know what's going to happen if you don't play this alternative investing strategy. But again, going back to this prototype, right? 20 deals over 5 years. And then also nice thing from a tax perspective, as these deals exit and you have depreciation recapture and capital gains, you're able to bankroll a bunch of passive losses. And when one deal exits, more than likely you're going to be able to pull off a lazy 1031 exchange, which is not a real 1031 exchange. It's just a lazy one that we've coined the term, where you have all these passive losses built up on your 8582 form, and then you offset that loss, and then you go into another deal either in that same calendar year, and then you get more passive losses from it, perpetually kicking the can down the road in the taxes. And that's from a high level the tax strategy. If you guys don't understand this, please shoot the team an email. We can send you a real starter tutorial video on this. And then the next step would be to start to connect with real CPAs that understand this stuff. You don't know how many people told me that, yeah, I talked to my CPA and they told me that I can't use my passive losses from this deal to offset my other passive income on my portfolio. And essentially all they're doing is missing that whole grouping election key. And that just goes to show, yeah, that's why 95% of new clients out there change their CPAs out there, because their CPAs just don't understand this type of stuff. I kind of digress there. Again, getting back to this whole prototypical example, one thing you want to try and do is avoid concentration of all your holdings into one area. Therefore, like max 10 to 15% in any one single investments. You obviously want to diversify your investments and spread across multiple offerings and asset types. Consider the vintage, like I said earlier, spreading your investments over many years. And also pay attention to the idea, is this a core investment or more satellite approach? Is this more of a lower risk? Have some thought into, do you want more lower risk, more higher risk stuff, right? At least don't just be picking eggs out of the basket. More like have some thought to just what do you want. Now, I would probably say this kind of comes into mind once you're in maybe half a dozen deals, then you can have this mindset where I think in the beginning you are just picking eggs out of the basket of people you trust. But that's where some investors who, especially are on the lower end of the net worth stage, and the growth years under $2 million net worth, may want to skew more towards higher returning, higher risk type of projects, more on the development side. Some would say asymmetric type of returns. Heck, some people may want to do crypto and all this alternative riskier stuff, right? That's also an option for people. But I think tailor your strategy and based on what your goals are. And what I mean, and I guess what I'm calling out, some investors want to grow their net worth from 1.5 to $3 million in the next decade. And you're still in those growth years. You better not just be buying a bunch of T-bills and just doing some accredited investor banking and thinking that's going to get you there. Make sure you have your goals you're aligned with what you're doing to get there. Because I want to lose 20 pounds. You're not going to go eat 4 donuts every single night. In a way, that's like investing, not a mismatch in your investments, as I said earlier. Another thing is diversify where the assets are held geographically, right? And this is where I think sometimes this alternative investment world, the syndication world, gives new investors or unconfident investors too much control. And I think this is unfortunately where traditional investments take advantage of this lack of confidence. Traditional investments, they have great marketing and they're like, we have all these PhDs doing all this back-end AI research for us. And it's at this point, it's nothing new, right? It's just a bunch of ETFs and picks based on their market cap. I think it can really overwhelm, or not overwhelm, but make investors put a lot of too much confidence in the traditional investments. And what a lot of people don't realize is they're paying for that. Right? How else do you think Wall Street companies have all these big buildings and all this bloated staff? It's coming out of your dollars, right? Your investment dollars. Essentially, you take on all the risks and they take your upside, whether you make money or not. Whereas in this world, everything is up to you and all the returns are up to you. And also the downside is up to you. It's definitely not for everybody, but financial independence is not for everybody. So there's a couple of strategies that I see from people. Some people they'll lean in slowly They will get this, they just want to test out people and then they'll move in more heavily. Some people, especially on the lower end of the net worth spectrum, under $1.5 million, they'll realize this and they're like, yeah, I can't, I don't want to play with the tax pal fund. I don't want to play with the pet fund because they're a little bit more categorized as lower risk, lower return. They're like, I want to go for the developments, right? Because that's how I'm going to increase my net worth. Then maybe I switch to more of a cash flow type of strategy. I myself, in the middle of this, we take more of an opportunistic strategy, and there are market cycles, ups and downs. Right now, that just means that we look for more types of deals where it's a little bit more like defensive in nature. So that this is why you haven't really seen us do any value add multifamily in the past well over a year, since interest rates going up. And I've been starting to look at real estate royalty, land agreements, other triple net type of holdings in various asset classes to produce better alpha than what's out there. But it's like, take what you can get at the moment. The example, if Shohei gives me 100-mile-an-hour fastball on the outside corner, I'm going to have to just go with it, right? Right now, it's just a difficult time with interest rates high, and you have to still invest, right? You can't just do nothing because then you will lose. But if you can find more defensive investments, such as I mentioned, then you're going to be going into the current, but the whole point is you're still making progress, which is why I look at the taxpayer fund, right? The taxpayer fund is a great example of that. When you back out your return of your own capital, you're getting about 10% a year, which is great, right? That certainly beats the market. But the big thing there is saving taxes. So it's like the situation where, you may not be making very much money, but elsewhere, like the holistic effect is people are able to lower their taxes way, way down and save a heck of a lot more money there. $100,000 of passive losses for one person may mean 40 grand in the bank. And when you add that to the $10,000 that they got, that's a 50% return in 1 year when you include those tax benefits. And a lot of people are not latching on to this whole idea, right? There's a lot of people that are just simply looking at the returns and not looking at the big picture, where some people who have jumped in totally get this. And I think the reason why that this is the case is I think it's this lack of a network. And I was here at one time, right? Like I was investing in a bunch of single family homes. I knew about the tax benefits of real estate, but until I got face to face with other investors, I had no clue. And it was funny, like I would go around to these groups, and now we formulated within our Hui group, and you'll see this in Las Vegas coming up. You'll have the right people. It'll be like shooting fish in a barrel. And we vet people coming, right? We want people who have the right mindset and understand this stuff to some extent. And you're going to start to hear ideas from other people, and you're going to start to really figure out how to use these types of investments and other strategies to really get that path forward. Where if you're just sitting on your computer all the time, yeah, you might have watched the 2-hour Tax Pal webinar. You likely might have just went right over your head. You need a guy. It's funny because I always say you always meet this guy at these things where they're just sipping their cocktail and they're saving several $100,000 of taxes every single year because they employ these strategies like nothing. And they've got a well-oiled machine in terms of they have their CPA who, they just do the same thing like clockwork every single year. And it's nothing that they have to do, right? They're just a passive investor, but they know how the game works. And this is where I'm huge on financial independence. Yeah, you get there, you get $2-4 million, whoop-de-doo, right? But I think a lot of us are aligned with passing down the money to our kids, but it's more than money. It's about the ideas. It's about the networks. If the kids, the next generation, understand how to work hard a little bit, save a little bit money, and then optimize it for investment and saving taxes, now they can grow their net worth, and then you don't have to give them any money. The big value was these ideas that we're talking about here. But unfortunately, what I've learned in 2016 doing the wealth elevator is unless you have a community and that peer group around you, it doesn't really sink in, which is why I'll say it, the older family office members, they'll bring in their kids, and at some point they'll bring in their grandkids, right? Because if they can have a chance meeting with another 20, 30-year-old within our group, that can really sink in and be like, wow. And I met this dude and he's working his computer engineering job. He likes it now, but he doesn't want to work it forever. But he really spelled out all this stuff. And yeah, I guess that's what mom and dad do. But now it makes sense because I talked to some cool guy and it wasn't my parents, right? It can also happen with other peers out there. Like I talk to people to death about this stuff. It really is the same thing over and over again. Alternative investments, the tax strategies, the credit investor, infinite banking strategy. It's all basic things once you've gone through several hours of these webinars, but it doesn't lock it in and doesn't get synergized until you hear how people are implementing this stuff on a small level and on a holistic level. And I guess I'm sure there's many examples of this. Maybe like the most recent one is like Black Friday deals. You hear that there's good deals here or there, but you may be somebody who's just whatever. Maybe until you haven't met some of these crazy shoppers, you don't realize how to tap the full potential. And until you're in vicinity to those people, you're just sitting there, oh, whatever. And in a way, it's why it frustrates me sometimes. It's like, why are people not taking advantage of these strategies? It's real money and significant money. If you have $100,000 of passive losses that you can use to attack your AGI, sure, you potentially need rep status, but a lot of you guys could get rep status pretty easily. Don't discount yourself because your CPA is just too lazy to find a solution for you. And you could be very close to using that $100,000 to drop your AGI and saving you $40,000 in taxes. And there's your next wad of cash to invest in the next deal to create even more losses and create this perpetual cycle, and which we call the golden hamster wheel. Pet fund should continue on as it has probably in the next 3 to 5 years. No deviation from the standard plan, and I don't really see that changing for quite some time. But with that, if there's no more questions, we'll see you guys next month.